Great Depression, the ultimate hangover after the Roaring Twenties. Did the gold bullet really save the day? How Federal Reserve, they fumbled the ball big time. Hey folks, welcome back to Money Talks US, China, Beyond. You have Chris Lee, your host here. A couple of weeks back, we had a pretty cool chat about the market crashes and their triggers, right? And wow, with all the wild ups and downs in the market lately, it's got me thinking. We should totally gear up for what feels like a crash that's just waiting to happen. So I figured, maybe, why not dive deep into some of the biggest crashes in history? Today, let's kick things off with a look at the Great Depression. What do you say? Ready to unpack that wild ride with me? Here's the game plan for today's wild ride. Our programs are packed with juicy bits, and you can skip around to whatever catches your eye with the timestamps we've just popping up on screen. First up, we're diving into the Roaring Twenties. Man, talk about one heck of a long, crazy party. Then we're gonna stumble into the Great Depression, the ultimate hangover that's gonna hit like a freight train. After that, we're asking, did the gold bullet really save the day? Spoiler, it's a wild, wild story. And finally, we're gonna wrap it up with Federal Reserve's epic misfires. Yep, they fumbled the ball big time. So grab your popcorn, pick your spot, and let's roll. Timestamps are your VIP passes to jump right in. Picture this. It's 1918. World War I just wrapped up. The US economy hit a wall for years. Government spending kept things booming, supplying tanks, bullets, and gears for the Allies. When the war demand vanished, so did the jobs. Soldiers came home to a flooded job market. Factory hit the brakes. On top of that, global trade was a mess. And farmers got crushed by plummeting crop prices. But the slump didn't last long. By 1921, the Fed eased up on interest rates, people started spending again, and the economy shifted gears to peacetime prosperity. Before long, America was on the brink of something huge, the Roaring Twenties, a decade of a wild economic and cultural explosion. It all started in 1920 with the first radio ad. And soon everybody is snapping up, vacuum cleaners, toasters, and electrical washing machines. Bank toss our loans out like a candy, sparking a credit craze. Suddenly, debt was cool to keep up that American shine. Before long, every driveway, got a Ford Model T, not Tesla, and you were zipping off to Charleston or chill with the smoke. Thanks to Henry Ford's assembly line magic. Production booms. Cars tripled to 4.8 million a year. Cities buzzed with new skyscrapers and the jazz clubs. Big names like Ford, Chrysler, and the GM, they just cash in. US firms go global. And by decade's end, America is making 85% of the world's cars and 40% of its goods. It was a party time. So, the average American is riding high in the 20s, flush with cash and looking for kicks. Another washing machine? Pass. A car? Already got one. Investing? Now that's the ticket. Why just be rich when you can be richer? The stock market turns into everyone's playground. Janitors, newspaper boys, and taxi drivers, you name it, all playing Wall Street tycoon, dumping life savings into hot stocks. The making money was so easy. People were not just buying with cash. They were borrowing to bet bigger. Margin loans. Yes, margin loans. We've beaten that dead horse. Margin loans piled up, hitting $8 billion, almost twice of all the money in circulation across America. And banks, they're raking in interests while quietly dipping into customer accounts to join the frenzy. That's a leverage on steroids. And they fueled a giddy go-go vibe. In the stock market, it was a rocket ship. Wells doubled, tripled, Dow Jones up sixfold since 21. But here's where it gets scary. By 1929, stock prices were untethered from reality. It keeps soaring, but production stalling. Henry Ford's Model Ts aren't rolling out like before, and folks not buying as much. Wages dip, easy money dried up, interest rates creep up, yet people kept buying, brushing off the Fed's warning and the cracks, and the party rolled on, peaking on September 3, 1929, with the Dow hit 381. It was a pure euphoria, until it wasn't. On October 24, 1929, bam! Black Thursday hit. The whole thing exploded. Market dropped 11% at the open, with 12.9 million shares traded. Record. People were selling so much the price tickers couldn't keep up with the volume. So people didn't even know what price they were selling at. Margin calls. Demands from brokers for investors to repay loans used to buy stocks forced more sales, accelerating the decline. Haven't we seen that before, right? Panic set in, and the bankers tried to prop it up, but it didn't hold. Then, the Black Monday, October 28th, another 13% plunge, breaking the record set just days ago. And Black Tuesday, October 29th, was the knockout punch, 12% down, 16.4 million shares traded, and 14 billion in values wiped out. The Dow crashed to 199 by November 13, 1929. That crash kicked off the Great Depression, the worst economic downturn in the history of the industrialized world. Starting from 1929, over the next 3 years, the stocks kept sliding until July 8, 1932, bottoming at 41.22. From 381 down to 41.22, a 90% drop, 90% drop from its peak. Some shares were now worthless. People have lost their life savings, and Americans who borrowed to invest were absolutely crushed, and the bubble just popped spectacularly. Banks started toppling like dominoes. Take the Bank of the United States in New York, one of the biggest at the time, in late 1930, yet had over 400,000 depositors and 200 millions in the vault. But bets on real estate and stocks, plus a full-blown bank run, took it down on December 11, 1930. That collapse set off a chain reaction. By 1933, over 9,000 banks had failed, freezing $2.5 billion in deposits. Some people got back just 10 cents on a dollar, others lost everything. Unemployment skyrocketed, jumped from 3% in 1929 to staggering 25% by 33. That's 1 in 4 workers, tens of millions of people out of job. And even those lucky enough to still have one wasn't exactly secure. Salaries in top professions plunged by 40%, almost half. Wages got slashed, hours cut, families had to tighten their belts just to go by. Bread lines stretched for blocks, soup kitchen overflowed, and homelessness became an everyday sight. For many, survival wasn't about living. It was about making it to the next day. Businesses were dropping like flies. Over 100,000 went under between 29 and 33, with 1932 being the worst of all. Over 33,000 bankruptcies in a single year. Even Wall Street darlings weren't safe. Eva Kruger, the so-called Match King, once a financial superstar, borrowed over $250 million before his empire crumbled. On March 12, 1932, he took his own life. and his company's collapse sent shockwaves through the global markets. Manufacturing took a beating too. Studebake's car sales plunged from 123,000 to just 46,000 in 1932, forced into receivership the next year. Smaller textile steel companies didn't stand a chance, as industrial production was nearly cut in half. Even retail was struggling. When people can barely afford food, shopping was the last thing on their mind. The economy didn't just dip, it crashed by nearly a third, 30%. Just for perspective, the 2008 financial crisis only shrank the economy by 2.5%. And the dot-com bubble, 1%. Great Depression was on a whole different level. Deflation made everything worse. Wholesale prices plunged 33%. Farmers, already struggling since the 20s, got hit even harder. Wheat prices nosedived by 70%, dropping to just 38 cents a bushel by 1932, making everyone's crushing debt, the loan, feel even heavier. Herbert Hoover, president from 1929 to 1933. He believed in, minimum government intervention, let it go, do nothing at first. A year later, he tried to stem the tide with voluntary cooperation, asking businesses to keep wages up, and later the Reconstructing Finance Corporation in 1932, which lent $1.5 billion to banks and firms, but it was too late. The economy just kept sinking. And by 1933, it was a full-blown catastrophe. No one was safe. Whether you invested, borrowed, or just had money sitting in the bank, the depression found a way to hit you where it hurt. Experts and the economists are still bitter over why the Great Depression hit so hard, so bad, and so long. Back in the day, most folks were scratching their heads, looking at stuff like, overbuilding or underconsumption to explain the crash. Picture the Roaring Twenties. Too many factories, skyscrapers, gadgets, all built on hype that didn't pay off. Or folks didn't buy enough to keep the wheels turning. That was the vibe back then. But fast forward to 1963. The story started to shift. It was money, or the lack of it, steals the spotlight. Big name free market economist Milton Friedman dropped a monetary history of the United States, 1867 to 1960, arguing the trashed money supply was the real culprit. Decades later, Fed ex-boss Ben Bernanke, many other economists and grassroots investors like Lynn Eldon jumped on board too. Turned out, the U.S. being chained to a busted gold standard was the choke point. Not enough cash, and they couldn't flow. Then President Roosevelt, FDR, swoops in with his wild gold ban and a dollar devaluation after stabilizing the banking. Controversial moves that flipped the script and started turning things around. Here's how this whole saga played out. So the dollar was pegged to gold, $20.67 an ounce to be exact. And anyone can exchange the dollar for gold at that price at the time. And there was no FDIC, deposit insurance company, meaning if your bank went belly up, tough luck. After the 1929 crash, we said it, over 9,000 banks, more than a third in the banking system just collapsed, wiping out billions of cash and deposits. People got back maybe 10 cents on a dollar or nothing. Folks really freaked out. Ordinary people stuffed their cash in jars, cookie jars, candy jars. Rich ones hoarded gold like crazy. $500 million worth of gold got yanked out of system by early 1933. The money supply, cash, plus saving and checking accounts shrank by a third, down to only 32 billion. Economy tanked. Debt soared to 300% of GDP from all that 1920 borrowings. Gadgets, cars, margin loan to buy stock, you name it. And deflation made it a nightmare. Prices of everything tanked. Wages dropped. Money vanished, but debt, they didn't budge, locking the economy in a doom spiral. Then FDR dropped his hammer. On March 5, 1933, he slammed a bank holiday, shuts every bank in the country down for 4 days. No cash, no checks, no loans, nothing. The Fed and the Treasury scrambles to sort through the math. On March 12, FDR was on the radio, promising only the good banks are coming back. And people bought it. Congress backed him up with the Emergency Banking Act on March 9. And by March 13, banks are back. Solvents, the good ones, are first. Shaky ones with a little bit help. And the busted ones got the axe. People started depositing again. The bleeding stopped. On April 5, 1933, FDR shocked the nation again, dropping Executive Order 6102, basically saying, hand over your gold by May 1 or face a 10 grand fine or even jail time. You could keep a little, up to $100 or some rare coins and jewels, but most of it gone. People turned in $300 million worth of gold, about 14.5 million ounces, stashed in Fort Knox later, which is about to be audited. Controversial? You bet. Folks were pissed. Government theft, they screamed. Then in January 1934, the Gold Reserve Act kicked in. FDR bumped gold price to $35 an ounce, devaluing the dollar by 40%. And the Treasury made a windfall, a cool $2.8 billion profit on the deal. And they used that for other New Deal spendings later. The gold standard was gone. Well, not entirely, but banks stabilized. The money started to flow and in fact exploded in the next couple of years. The stock market, which was a total wreck in 32 and 33, hitting rock bottom, suddenly springs back to life. Shot up over 60% in a mere month. Everything started costing more too. The weaker dollar flipped the switch on prices. Inflation came roaring back. Farmers were happy, as the wheat prices climbed. Exports got a sweet deal because they were cheaper abroad. Economy, it popped 10% in 1934, going strong until 37, 38. Unemployment dropped from 25% to 14%. Now here's the kicker. Debt, the loans, they didn't budge. They didn't change amount. They stayed fixed. So people were able to pay them off with those less valuable dollars. And boom, debt as a chunk of GDP shrank fast. The money supply kept ballooning for years. But then, 1937 hits. And then we stumbled into another recession. That slump spiked the next big money surge and didn't let up until well after World War II. So, with all that war demand pumping things up, the Great Depression finally said, see ya, in 1942. But get this, the stock market, it didn't claw its way back to those 1929 highs, the 380-something. Way back, guess when? 1954. That's right, 25 years later. Can you imagine the patience that took for those folks who bought at 380 back in 1929? Most experts like Freeman, Bernanke, and the modern macro folks say these moves didn't end depressions. That's World War II's trophy. But they flipped the script from doom to climb. The gold standards choked. Deflation, tight money was the villain, and FDI's trial was the counterpunch. Not everyone is on board though. Gold fans like Ron Paul still complain, calling the ban a shameless grab of private property, which it was, and devaluation hit to savers' pockets. Amity Schillis and some historians argue that both these monetary moves and the New Deal were overhyped, with 37 stumbled as proof it wasn't all rosy. But the big crowd, economists, Fed insiders, and data geek researchers, mostly agrees FDR's move were a messy, imperfect lifeline that yanked the U.S. out of the deflation swamp and set it up for the recovery. Not perfect, but it worked. Now, you might be wondering, where the heck was the Federal Reserve while all those things going down? Let's dive into the Fed's big blunders during the Great Depression. Yes, they screwed up big time. Milton Friedman and Anna Schwartz totally flipped the script on this in their 1963 banger, A Monetary History of the United States. They pinned the economic meltdown on the Fed's monetary fumbles. And here's the juicy rundown of their 4-point flop in a nutshell. First up, 1928's tightening tantrum. The Fed jacked up interest rates starting in spring of 28, freaking out over Wall Street's speculative party. Think brokers and the stock mania. The economy, though, was barely out of recession. Prices were chill, but nope, they squeezed anyway. By October 29, the stock crash hit, and Freeman says the tight policy sparked the Great Depression that fueled grand stock crash, not the other way around. Oof, talk about the buzzkill. Next, 1931's gold panic misfired. Britain ditched the gold standard in September 31, and speculators eyed the U.S. Dollar next. The Fed obsessed with defending gold reserves as $500 million got yanked, hiked rates again, right when banks were crumbling and the economy was tanking. They saved the dollar's honor, but trashed everything else, trashed the economy harder. Bold move, wrong target. Then 1932's half-hearted flip-flop. By spring 32, Congress was begging for relief, so the Fed eased up a little bit. Open market operations dropped rates and paused the freefall, but they got cold feet. Some thought the Depression was supposed to purge the excess. Others misread low nominal interest rate as easy. Deflation made real rates brutal. When Congress took a break in July, the Fed reversed it and bam, the economy nosedived again. So close, yet so far. Finally, banking crisis neglect. From 30 to 33, we've already been through that. 1/3 of the banks, 9,000 shut down as runs raged. What did the Fed do? Just watched. They could have flooded cash to stop the bleeding, but nah, too many believed in letting the weak bank die. Deposits vanished, the people hoarded cash in coffee cans, and the money supply cratered by 1/3. Credit dried up, and the Fed shrugged. Brutal, brutal oversight. Freeman and the Schwartz say these flops, tightening too early, gold obsession, wimping out on easing, and ignoring bank runs, shrank the money supply and tanked the prices and the economy. The Fed turned a downturn into a disaster. Wild, right? There you have it. So what are the takeaways for us from this deep dive? Right now, very few people remember the Great Depression's brutal days. bread lines, bank runs, massive job losses, but we would be total fools to forget those lessons. The Great Depression just showed us how things can happen, how insane things can get when greed and the fear spiral. Speculations gone wild, debt stashing up, and then boom, crash city. Yet the greed and fear, they're not dead. And the speculation, they're not dead, my friend. They are lurking in every market move. You want a crash-proof strategy? Check out our dedicated episode. So, what do you think? Are we headed for another mess, or are we wiser now? Hit the comments. I read it, everyone. And if you love this video, smash a like, subscribe, and ring that little bell. More booms and busts coming your way. Until next time, keep your eyes on the markets and your mind sharp. This is Chris Lee, signing off from Money Talks US China Beyond. See you in the next one.